Welcome to the Finance Podcast. The topic of this episode, Active ETFs by Erhard Radatz, Christian Baltio, Oliver Paquier and Ivan Dedevic, moderated by Stefan Meyer.
Okay, good afternoon ladies and gentlemen, and welcome to the panel discussion on active ETFs. My name is Stefan Meyer. I'm working at Twy Wealth. We're a consulting firm mainly for private individuals but also for institutions. Before we start, I want to quickly introduce the panel and maybe then one or two housekeeping items before we really get going. Starting all the way to your left is Erhard Radatz. He's the Global Head of Portfolio Management at Invesco. He was appointed Global Head of Portfolio Management in 2024 with responsibility for the implementation and communication of equity factor and systematic multi-asset strategies globally. In his role, he oversees the client portfolio management activities with team members in Melbourne, Tokyo, Frankfurt, and the portfolio construction and trading team based in Frankfurt and New York. He joined Invesco in 2017 as a portfolio manager focusing on balanced accounts and capital-protected products. He holds a master's degree in theoretical physics from the Humboldt University in Berlin. Then to the next to Erhard is Christian Balteo. He's the head of investment products, multi-assets at Nordea. He leads an international team of investment specialists at Nordea Asset Management, focusing on the multi-assets team risk premia portfolios. Christian joined Nordea in 2013. Prior, he spent 6 years as a fund selector at a leading Spanish independent financial advisory firm and 4 years as an equity trader. He holds a Master's in Science in International Relations from IBEI and an MBA from ESAT Business School. Then next to Christian is Ivan Đurđević. He is head of the ETF distribution for Switzerland, Germany, and Austria at JP Morgan Asset Management based in Zurich. In this role, Ivan is responsible for leading and further developing JP Morgan's asset management ETF business in all 3 countries. Before joining the firm in 2018, he worked at Amundi for 7 years. Last but not least, to my right is Olivier Paquier. He's the global head of ETF sales at AXA Investment Management, part of the BNP Paribas Group. Olivier is the global head for ETF sales. Prior to joining, he led JP Morgan's asset management ETF distribution teams for continental Europe.
Same firms.
And he holds a master's degree at from the Sorbonne, and an MBA from the Paris School of Business. So with this, I would like to make it as interactive as possible. I mean, we're here for you, and we would like to answer questions that you are really interested in. So I have prepared a few questions to get us going, but as soon as you have something that you think, I actually would rather have them talk about this or that, just interrupt. Also, if we're discussing something and you feel there could be more said to the topic, just intervene and ask a second or a third question, because the more interactive, the better for you, I think. And with that, I would like to kick it off. Active ETFs are often described as the next evolutionary step in asset management. So what problem do active ETFs solve that traditional mutual funds or passive ETFs do not? It's a question to all of you, so feel free.
Okay, so I start. I do think, first of all, it obviously solves something which passive doesn't solve, and that is that you have an outperformance potential. By definition, passive is trying to replicate the index, so what you will receive is index minus fee. That's just the definition of passive. And if I look into what does it solve compared to a classical mutual fund, it is about the liquidity of trading an ETF. Obviously, the ETF comes with a secondary market liquidity, but I would also emphasize the element of, in an ETF, who trades pays. That is not so clear for mutual fund. You have gating processes and so on, but to some extent, there is always a bit of a blur. You have an inflow, the portfolio manager is investing that. In an ETF, you receive in-kind inflows, and that automatically aligns a bit for a long-term holder. The ETF is actually a better tool. I find it pretty interesting because everybody thinks of an ETF as being something like a short-term trading vehicle, but I would actually argue it's the opposite. It's actually something what really aligns with a long-term investor.
Yeah, so I'm probably the least prepared speaker in the panel and also the least active ETF focused speaker in the panel. I think it depends. It widely depends on the type of strategy we're talking about. If we're talking about probably all of the strategies us are pushing or distributing or that are more successful, we're talking about active enhanced type of strategy, either by research, either by multi-factor risk premium models, but it's kind of the same. I agree totally with you that it solves the problem relative to passive ETFs, that it can actually generate alpha consistently. And I think the alpha is the best advantage against passive ETFs, and the consistency is probably what it can add compared to higher tracking error, higher active strategies in the mutual fund space or in the investment fund space. That is a consistency that I think most of our active high tracking error competitors are, let's say, struggling with in a very concentrated market environment. Investors want alpha, they like alpha. Historically, they have been very active, but they have been disappointed again and again and again over the last few years. So they can do two things. They can go passive, then they renounce to any possibility of generate excess return, which compounded over the years are super good for a portfolio. Or they can go into this type of enhanced active strategies that can deliver alpha consistently with a limited risk budget, with a limited tracking error. Those strategies are also available as mutual funds in many cases. In some cases, they're only available as active ETFs. So from my perspective, what the active ETF adds on top of the mutual fund space is the tradability intraday, which is important for some discretionary institutional clients, to some extent also to retail clients, even if I don't know if that is more dangerous than beneficial. And they also have the transparency, obviously, at least in the standard historical ETF vehicle that has to disclose holdings on a daily basis.
I think I'm the next. I think active ETFs at the end of the day combining the best of the both worlds, the ETF world and the active world. And if we first look into why the ETF actually became successful, it's the transparency, the liquidity, basically also cost, withholding tax advantages here in Europe, for instance, if it is an Irish domiciled ETF, for instance. You also have portfolio efficiency on the ETF level. All of these are ETF benefits that investors like. They like to look into the portfolio. What did I actually invest? On the other hand, you have active strategies. We heard quite a lot. It's basically the aim of outperformance. I would even say not always the aim of outperformance. It can be also an outcome-oriented strategy. Risk reduction depends on actually the aim, the target of the strategy. That is quite important. Now you're blending with the active ETF actually these two disciplines. One, the benefits of the ETF wrapper, and actually something good, a good strategy. Index doesn't mean it's good. Index strategy or index replication is simply a way of how you're doing your investments. I would put in another way. If you think about the ETF simply as a wrapper, think about something. I was born in the 80s. So in the 80s, there was a nice advertisement from a detergent company with Heinz ketchup at the end of the day. If you recall, there was a glass bottle, and every time you want to have your ketchup, sometimes was quite heavy. I'm wearing a white shirt. You end up in having maybe the ketchup on your shirt to basically squeeze it out from the glass bottle. What came up was the squeeze bottle with Heinz ketchup. So you immediately got your ketchup basically perfectly squeezed on your plate, however you wanted to have it to your dish. Today, you don't only have ketchup, you have mustard, mayonnaise, barbecue sauce. I have Croatian roots, even Ivar is available in the squeeze bottle. And that's basic when you think about investment. If you have a great strategy, why not putting it into the ETF wrapper to actually get like a good solution in an efficient vehicle?
Well said, Ivan. And of course, I go right after him. No, maybe back to your initial question, Stefan. I would say that, in my view, the active ETF wrapper is not an evolution. In the asset management industry, it's really about being a mini revolution. So with an R, revolution, not evolution. The reason is manyfold. In my view, over the past 20 years, I was also born in the 80s like Ivan. I noticed that the usage of ETFs has started with simplicity and the ease of trading, and it's still applicable to actively managed ETFs. And I think that actively managed ETFs help on two things in particular. First, democratization of active management. Many investors did not understand what they were really doing with mutual funds, sometimes with tilted/smart beta ETFs. And I think active ETFs enables clients to understand and put a word on something that they're actually doing within an ETF wrapper. And the second thing is, I think for most institutional and I would say more discretionary portfolios, they're adding agility. I would not necessarily agree that ETFs, passive ETFs, necessarily mean index minus fees. They can solve many things, but actively managed ETFs definitely help investors in Europe and across the world to access some risk management, some savings on certain costs. I'm thinking in the fixed income space. ESG convictions can sometimes only be achieved through some active management and the agility and the flexibility of active management. And when you combine it into an ETF wrapper, bingo.
Can I just say, maybe with an add-on question for you, where do you see the strongest demand for today in today's world for active ETFs? Is it institutions, wholesale, private banking, and what's driving the demand?
I would say we see across the world demand on every single client type, maybe less so within the retail investment space. I'm thinking of three reasons that are quite obvious when you work in the asset management industry. Fee compression. Lots of investors, regardless of their convictions on active, passive, you name it, management, they're bound and constrained with saving costs. That's the reality. So that's valid for the portfolio management. That's valid for the selection teams behind. When you try to select some vehicles, sometimes you have to run a very thorough and long due diligence. With ETFs, it tends to be standardized. It can be long as well. We've all gone through that, but it tends to be standardized. And most importantly, the transparency, the daily transparency offered by the wrapper enables clients to make decisions for themselves. And I think that's important as well. The other reason is staff compression, in my view. There's lots of, we meet with many clients every year. In my team, we're counting over 5,000 meetings. And clearly, there's staff reduction in every direction. And when you're constrained with time and constrained with staff, what do? You go through solutions that are easily accessible, that are public, that are easily verifiable, that you can plug in your Bloomberg terminal or your data terminal, whatever you monitor your risk with. I think these are the main reasons. The variety of the ETF offering is probably the second biggest reason why investors are starting into active ETFs. There was no active ETFs 10 years ago. There was, I think, 3. So there was no optionality, if you will, in terms of variety of exposure. Right now, the asset management industry innovates through the active ETF wrapper when we talk about active management. And I think that's also a direction of travel. Maybe you have questions about this that we're observing in the industry, that the future and the growth of not only the ETF industry, but the active management industry is leaning towards.
I think the ETF here in Europe first started with a professional investor as allocators in the passive space, and then later on the retail investor discovered the ETF as a wrapper as well. So when you look into markets like Germany, where the retail investor is already 1/3 of the investor base, shows already the direction of travel. So when you think about active ETFs, and by the way, ETFs coming to Europe always had a delay of approximately 5 years compared to the US. So when we look actually also into what's happening now in the active ETF space, first in the US, 2018, when actually we both were working together, there was technically almost no active ETF market in Europe, so we basically started to build it up. And at the beginning, there was a lot of skepticism, like, why do I need an active ETF? What's my benefit? Also to your previous question. But then when you showcase the solution, what active ETFs can actually bring to the table, then we saw like the first clients understanding which benefit an active ETF can be in their portfolio construction. So when you think about research-enhanced indexing, it's at the end of the day beta 1. But long term, it aims to deliver an excess return. And a few couple of basis points can be quite impactful over the long term. So that's basically the first step. The second step is, of course, fixed incomes. Fixed income, when we heard already, I don't know any fixed income ETF that can outperform the benchmark. It's by definition not possible. But when you look into the European market, 80% of all fixed income allocation is actively managed. So if you're going to combine the efficiency of the wrapper with actually a good active strategy, this is going to unlock the full power of the ETF to create this power tool of active fixed income ETF. That's the second part where we are receiving a lot of questions from clients. Of course, the offering was not there yet, so this is now being built, so investors are getting the choice to pick and choose what they would like to have. And the third component is outcome-oriented solutions. You would be surprised how many clients are actually aiming or would like to invest into an outcome strategy. Outcome can be, for instance, income generation, and I'm pretty sure everybody here in the room loves to get income. So when it basically comes to your account, so that you can continue spending. So that's basically what we all want. So there are also a huge investor base that would like to have monthly income generation. And that's basically what was now created. And to your point, not retail investor, you would be surprised how many retail investors are actually investing into equity premium income ETFs these days. So there is a demand, of course, at the beginning, to come back to your question. Professional investors, asset allocators, pension funds are already looking into active ETFs, and now even the retail investor is starting to look into them.
I think we have a question in the audience.
Yeah, sure. Go ahead. No, I think. Oh, there is a mic. Yeah. Okay.
Yeah. I'll talk loud.
We'll repeat otherwise. Yeah.
Two questions. They're connected. Sorry, you record, so we need to use the microphone.
Okay.
Okay. Let's try again. Okay. So two questions. They're somewhat connected. First of all, if I have an ETF, especially an active ETF, in terms of investability or availability, are those products that once you set it up can be bought globally? Or is there, like with SICA funds, US mutual funds, is there a certain jurisdiction of sort? Question one. And the other one is, with mutual funds, especially active mutual funds, you have the option of having a tiered share class program where you have institutional retail. Is that possible with active ETFs too? Or what is being done in the market right now?
Happy to answer the first question. It depends always. Also, an ETF is a regulated product, so it's going to be hard for you to buy a UCITS ETF in the United States, for instance. On the other hand, if you have a US ETF to market the US ETF in Europe, is quite difficult. Switzerland is a kind of for qualified investors possible to invest in, but I can tell you in the rest of the European Union, it's almost impossible to invest into an US ETF, no matter active or passive. So you're going to have like the same challenges. And to your question, second question in terms of ETFs, an ETF is exchange trade fund, so it's exchange traded. So if you have the tiering like institutional share classes, retail share classes, to be able to access the institutional share class, of course, every asset manager has, by regulation, ensure it is actually an institutional investor to be able to invest into that share class. So with an ETF, since it's publicly listed, you could not ensure these type of things.
Fully agree with what Ivan said. Maybe I would just add one thing for everybody in the audience. So outside of the US and Canada, these markets are really the two exceptions. The global brand for, I would say, global ETFs is UCITS. There's many countries, I'm thinking of Brazil, Thailand, Mexico, that have their own locally based ETFs, but the global brand is UCITS. So as long as an ETF is listed, it can be traded by any broker. And if it's registered for sale, it means that we can push for those ETFs and discuss those ETFs locally. But it doesn't mean that you cannot buy it. You know, like it's fine. I mean, there's many countries, and we see investors from many countries who are not where we're not registered for sale, and those investors still buy our ETFs. And the second thing that is more of a recent evolution is that there's lots of providers, and maybe that's also the way that the asset management industry is looking at ETFs, where ETFs tend to also be listed share classes of existing mutual funds. So they keep, if you will, the infrastructure of the mutual fund, so with various share classes, but there's also an ETF share class. And an ETF is just one share class, so it's available to anyone. So there's no specific tiering on the ETF share class itself, but there tends to be a sort of a fungibility of the various share classes at the vehicle level. Having said that, not everybody does that. Not in every market. It's an ETF is an ETF, and it could be a share class or not of an existing vehicle. Sure.
I would actually like to take the advantage to maybe merge the question from the audience. So, yeah, demand is coming pretty much from everywhere. I think mostly institutional and wholesale/discretionary clients, fund managers, discretionary portfolio managers. I think that's where we see more of the demand. Of course, there is demand also in retail, and I think that is aligned with the democratization that active ETFs bring for active management. But there is an elephant in the room, which was your second question. It is an evolution for asset management, but I think it's a revolution for wealth managers. So it's a revolution for our clients, the distributors, because there's no tiering. So that means that all of those markets where kickbacks, retros are necessary to keep the wealth management business going on are going to be severely disrupted by active ETFs. So I think active ETFs are an excellent solution right now for all of the parties involved in the industry, as long as they are priced the same way than in the funds. And that's where I think the advantage of the wrapper, of the active ETF wrapper, is on these enhanced portfolios, these low tracking error, which are normally priced very attractively, not as low as passive, but lower than active, and where you can align the mutual fund vehicle with the ETF vehicle in terms of cost, and then it's just for the investor to select which is the wrapper that they want to invest on. So it's not really, I think it heavily, you cannot completely dislocate the question about the wrapper from the underlying strategy. It is very good for some strategy. It is, I would say, a growth opportunity for our industry if the right strategy is the underlying, but it can also be severely disruptive if we're talking about a mismatch in terms of the underlying strategy and the fees and who benefits from that or there. So,
actually, we gave the investor the choice. If they would like to have, we have many ETF strategies that are also available in the CCAF structure, and we leave it to our partners the freedom of choice. If they prefer the ETF or any other CCAF structure.
Which is the same we do also in our case.
I think there's another one.
Sure.
As a follow-up question on the elephant in the room, so with the fact that with the active ETF, the wholesalers would no longer benefit from the retros, which basically that's the point. Are you seeing new type of incentive frameworks being developed to try to compensate for that, or?
I don't think it's a new framework to try to compensate for that. I think our distributors are being more active and proactive and aggressive on discretionary portfolio management services, where they can charge a fee for the asset allocation service, and then they use the building blocks that do not have an underlying kickback. I think that's a very old model, but I think they are all betting much more for that type of approach than for the whole, I select whatever mutual fund it is, and then I get a retrocession. That comes with complications from markets. Investors, the end client is not used to pay a bill for the service they get from the distributors. In some others, it's going to be less problematic, but it's disruptive, I think. Not that we're missing disruption sources everywhere else. I
would like to turn to a topic about liquidity. So You talked about the benefits of the wrapper and it being one of them being liquidity. Can you elaborate a little bit more? What is really so much better when you buy ETFs as opposed to just buying mutual funds? And then in particular, we're coming back to liquidity when we talk about active, if there's problem associated with that.
Yeah, obviously an ETF you can buy whenever the exchange is open. So you can buy it throughout the day. Whereas for a mutual fund, there's one NAV point which you either hit or not. And if you don't hit it, you execute a day later. So in an ETF, you can have a risk price at every time of the day. Most likely, people actually don't choose to do a risk trade. So most of the people actually choose to trade an ETF on NAV as well. Due to cost efficiency, but you have the flexibility to, if you really want to get a risk price now, I want to get out of the market now, you can do that. That is not possible with a mutual fund. If I want to do it now with a mutual fund, I have to wait until noon tomorrow.
Yeah, I think it's a tool that it's ideal for tactical asset allocation. So if you want to react in the middle of the day and take a position or reduce your position, the active ETF gives you that. That comes at a cost. The total ownership cost. I do not necessarily agree that in terms of costs, active ETFs are necessarily better than funds. Again, if it's ceteris paribus, the same strategy on both vehicles, I think costs are similar or in some cases could potentially be lower in the mutual fund if the asset manager is responsible in terms of gating mechanisms such as swing price. I think for those that are going to be heavily active on active ETFs, they will end up paying a price in terms of bid-ask spread that will go into the one of the beneficiaries of the disruption, which are the brokerage firms, instead of the traditional private banks and so on.
Actually, I don't see, or we don't monitor in our ETFs a big difference to a passive ETF with the same exposure. Depends, of course, the spreads is always an outcome from the exposure that you invest in. For those here in the room that don't understand how it works, so when you think about US equities trade at close. Basically, there is no spread involved at the closing auction. There's no taxes involved. This is why creating US underlying is less than 1 basis point. However, if you think about European equities have financial taxes in Spain, Italy, and so on, which makes it quite expensive. So it's 20 basis points of creation fee. When you think about fixed income does not have a closing auction, so you always trade with a spread. Hence, also the spreads depend on how is the underlying spread. I would partly disagree what you said. I would rather agree to you. The ETF can actually reduce the transaction costs, especially in market stress situation, because the way how ETFs perform is you have the secondary market liquidity, which means if, let's say, Olivier wants to sell, I want to buy, even if the underlying market, let's assume fixed income, dried out, we can still get a price. Is it going to deviate from the NAV? Definitely yes. Why? Because the index, as also the NAVs being calculated with the last traded price, since there's no price, of course, artificial it looks higher than it is actually, but still we can trade. So he can sell, I can buy, and this is a liquidity that the market wants to have, the price discovery, even in market stress situation. And that's a huge benefit of the ETF wrapper. It adds additional liquidity, and the active ETFs at the end of the day is using the same mechanism as any ETF as well. Anything to add, Olivier?
I would say, and you can gain efficiency on this with active management, especially on fixed income. One of the biggest dichotomies that we're observing both in terms of liquidity and product offering is that in Europe, we are the fixed income continent. We're a continent where we love fixed income exposures. Fixed income is by essence and nature hard to access and active. It's hard to address the natural liquidity of a bond. They're not all listed, as we know. And going through an active fixed income ETF would sound like the most logical solution, where most of the ETFs in the active space, 71% of them are on equities. So there's a sort of a dichotomy, maybe a catch-up that the industry will play to sort of help broaden the spectrum of possibilities from mutual funds and from passive vehicles as well, including ETFs.
Okay.
If I may, I add just something really quickly.
Sure.
I do agree with Ivan. It gives much more tools in terms of liquidity. It is more liquid in that sense. What I was trying to refer to, and maybe I didn't say, is that I don't think it's necessarily less costly. It is more liquid. It comes at a price. It comes at a premium. Everything in this world has a cost. I think liquidity has a premium. If you want to have the intraday liquidity, you will potentially pay a higher price because even if you trade end of the day in the US, during the day in Europe, Asia is closed. We're talking about a global portfolio. Whomever is selling you has to think, okay, at which price I'm going to be able to buy and or sell when I'm able to trade. And that assessment has a price because it's taking a risk. So yes, it improves liquidity, but it comes at a cost. And now I don't want to come across as the one who's trash talking active ETFs here. We have active ETFs. We have them available as well as mutual funds.
It would be, by the way, the same also with a passive ETF. That's the ETF structure.
Yeah, that's fine.
Because what you are
Those
having,
I don't like either. Don't worry,
okay.
I don't have them.
We love ETFs. But no, the point is, I completely get your point, because if you, let's take US equities as an example. If you trade US equities at the closing, at the NAV, it's going to be 1 basis point, simply because nobody's taking a risk. But of course, if you're trading on exchange, it's going to be 5 to 8 basis points of spread. And that's basically where you're having, of course, somebody that is taking the risk and charging for this risk.
The point what I wanted to make is, as a long-term investor, you don't care in an ETF whether people are trading in and out. Because these people who are trading in and out, they take the transaction cost. Full stop. You as a long-term investor are never influenced by whether somebody is getting in and out. And that is the difference to a mutual fund. So even if you have a good gating process, and I assume every fund company has a good gating process, but those taxes, they are just there. So if you have a fund which has continuous inflows and outflows, somebody has to pay the taxes, and they are distributed across all holders of the fund. Whereas an ETF, by definition, the one who trades gets in and out. So as a long-term investor, you're actually better off in an ETF for the reason that when people get in and out, you don't care.
Can I add something?
Sure.
That's a long cost discussion.
This is getting interesting as we go along.
No, because maybe for everybody in this audience, to help you as well understand the liquidity mechanism, there's the natural liquidity of the product and of the underlyings within the product. Of course, we chose fixed income. We can choose any type of equities, emerging markets that are very hard to reach. All of that would be very valid. The big difference between ETFs and any other listed instrument, there's one. ETFs has market makers, which means that if I'm trying to sell my positions in an ETF, but Ivan is in Hong Kong and is asleep as we speak, and he cannot buy mine because he's interested but he's asleep, then there's a market maker, there's a professional market maker that actually makes the market that will take my order and execute it from me. That's the big difference with the bond market, and that's the big difference with any type of equity and cash market. I don't have to wait for a buyer to be ready to get my position if I want to sell. So it comes at a cost, it comes at a price, but this sort of continuous liquidity, I don't want to use the word guaranteed because it's not guaranteed and it's not us that provide this, is one of the key options and one of the things that you guys have to watch when you choose an ETF, is who are the market makers behind, making sure that you're comfortable with that. That was not related to this.
So it's sort of continuing in that direction. There's one topic that I really don't understand very well, but you probably all do, and that is synthetic replication. So if you actually don't buy all the underlyings, but you go in with some swap structures and so on, can you elaborate a little bit and illuminate us what's actually happening, and is there a risk in all of that?
Yeah, maybe. As Invesco is doing that quite extensively for the passive range. Let me briefly explain what this is. So replication is only a topic for passive ETFs. That's not a topic for active ETFs, because active ETFs don't replicate anything. They just buy securities. Replication is always a question of how you track an index. And there's a possibility to track an index not buying all the securities of the index, but rather buying a sample set of securities and using derivatives to get the index return. And for some markets, that is tax efficient. And for the US market, if you have a very liquid underlying index, it is tax efficient to do that because you basically can receive gross dividend and you don't have to pay withholding tax for those ones. So and something similar happens in China for different dynamics. But what you basically do in there is you buy a basket of securities. They look very much like the S&P 500, but they are not the S&P 500. And you use some kind of swap constructions to do this with investment banks. And as I said, it has a tax advantage for US equities. And that directly plays into some potential for that one. What's the risk about that? Yeah, you take counterparty risk. Obviously, you have a derivative contract, you take counterparty risk, but you can manage that counterparty risk as you can manage any counterparty risk. By the way, in all funds, you have counterparty risk embedded because all of the funds are doing security lendings, or most of the funds are doing security lending. Security lending has a counterparty risk similar to that one. Also, the counterparty risk is manageable. If you have a basket of US equities versus the index, it is actually the counterparty risk is only on the difference between that basket and the index. And if you manage it well, you can actually manage that counterparty risk. It's not my topic. I'm not managing them. It's a sister team of us. But it's actually quite efficient way to replicate something like US passive securities and Chinese securities.
Yeah. In our case, we don't offer them either. So if I already came across as the guy who doesn't like active ETFs despite the fact he sells active ETFs, if I comment on synthetic replication in my comment and wars out. But I agree in the sense that pretty much every investment vehicle that has underlying derivatives has counterparty risk. And I assume that among responsible asset managers that know how to manage and spread around that counterparty risk, that is, of course, manageable. Where I would maybe disagree a little bit is on the securities lending, which is not necessarily a practice that we all do, particularly in the context of sustainable or responsible active ETFs, where you want to be also an active ownership, because normally that's aligned with the values and principles of the investor who's looking for this type of vehicles. And then securities lending while being profitable and maybe gives you a few bips of excess return extra, it doesn't allow you to probably act as a responsible active ownership. So there are some goods, some pros and some cons as for everything. But again, in our case, we do physical implementation of active. So it's not replication.
Now I have to respond to that. Actually, you can also do security lending in a sustainable product. You just recall it when you want to vote on the share. So it's pretty easy to do. There's one time a year where you want to vote on a share, just recall it for this day, vote on the share, and then lend it out again. So it's possible also for a sustainable fund.
Engagements are a bit harder to achieve that, but yes, I agree.
I have a question about active alternative ETFs. If you could tell us a little bit about the trends and developments you see there. Which type of active alternatives do you see, and which kind of clients are demanding that? Thank you.
Okay, now I have to represent Invesco again. So that's not a quant topic. So obviously quants, you could do liquid alternatives with quant. First of all, in a UCITS ETF, you cannot run most of the alternative strategies you would be thinking of because UCITS, the S in UCITS stands for securities. So like you find a lot of loan ETFs in the US. That would not be possible to bring into a UCITS ETF just by the definition of what a UCITS fund is. So you see that there's more ETFs in the US side because the regulation is just a different one. Nevertheless, you can securitize something like a loan. You can put it into a CLO, and you can launch an ETF on a CLO. So that's something which you see right now. Interestingly, the Irish regulator basically says only the AAA tranche of CLOs is eligible to be an underlying for an ETF. So you see quite a range of AAA CLOs coming up. I would argue you can only launch them as active ETFs for the reason that the underlying is pretty complex. So benchmarking within the AAA CLO space doesn't really make sense. But you kind of see that as, I would say, the first one. Do I think that we will see something like a I mean, obviously you could also launch a listed non-UCITS fund, so an AIF, in regulatory speaking. Do I see that? I think there are some people talking about that. Right now, you haven't seen the market picking it up. It might be that that is going to happen in a couple of years, but right now you don't really see that the market is doing listed AIFs which are not UCITS. Technically, it's possible. Question is a market demand there? I would be doubtful about that, just from the demand picture. And technically, if you can buy, by the way, if you can buy AIFs, basically US ETF you can classify as an AIF. So you could, if you're a qualified investor who can buy that, you can already buy this BKN or whatever, those US structures. You could buy them anyway. So if you want to have bank loan ETF, just buy the US one. If you're qualified, you can do that anyway.
I'm just looking at the time. We've already run the course. It's 4:10. Maybe one or two questions left for if somebody wants to have another go from the audience. Then I would ask my last question in that case, and it's on the transparency that you offer, and doesn't that actually create a problem for active management? I mean, if you basically have to divulge on a daily basis what you do and what you buy and sell, and everybody can see it, isn't that the essence of a good active manager, that he can sort of profit from his good ideas before everybody else knows what's happening?
Well, we feel very comfortable with the transparency that we're giving to our investors and clients. So when you look into it, and we heard here also quite many times, like maybe not too active. Actually, we already have in the US equity space highly concentrated active strategies, fully transparent, 80 to 100 stocks in it. So we have this already, US value, US growth, also US core. So a highly concentrated active strategy with full transparency. We feel quite comfortable in providing this transparency to our investors. And when you think about fixed income, also highly active strategies, completely transparent. And this is what the ETF is there. The ETF is a transparency vehicle, and we feel very, very comfortable to provide this transparency through the ETF wrapper to our clients.
It's the same for us. We have, at BNP Paribas Asset Management, we've launched 26 actively managed ETFs. We have a range of products starting from what the market used to call smart beta / systematic exposures with tracking errors below 2%. And this is, by definition, not a problem at all to be transparent. But we also have some fundamental strategies with some exposures with 2 to 5% tracking error budget. And it's not a problem at all. I mean, the market, and especially in Europe, is very curious to know what is it that we're doing, and we're very comfortable with that. So we wouldn't launch an ETF if we were not comfortable with being transparent on a daily basis.
I think for the enhanced range, that is fully clear. You don't take big positions. So if you have an enhanced ETF, you can be transparent just because nobody is cornering you by definition. I would be a bit more cautious for more concentrated strategies, if I'm honest. I mean, we already trade our portfolios using algorithms and dark pools and whatever to kind of hide any slippage in that one. So I would be a bit cautious to really run a concentrated portfolio in a fully transparent vehicle. But there's also the possibility to run a semi-transparent ETF, so where you basically only disclose to the market makers, but not to the whole market. So that is possible. That is already being done in the US. It is also now coming to Europe. As said, Europe is always following 5 years. If you want to know where the trends in Europe will be, just look into US and approximate 5 years. That's a true statement. Yeah. And then you see where active ETFs still have room to grow. Just look into the US and see how much more market share they have in the US and how much of the product launches in the US are actually active ETFs. So I would say there's also the possibility to go semi-transparent for those ETFs.
Yeah, I concur with Erhard. I think we're also fully comfortable with daily transparency on the active enhanced solutions that we manage today. I think we will need time to understand how this will work with high tracking error strategies, but then you also have the semi-transparent option right now, particularly in Ireland, where you can tackle that. So I don't see a challenge from that perspective.
Okay, then that I think brings it to a conclusion. Thanks very much for the panel. Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory. New episodes are released every Tuesday and Thursday.